Hi guys, Portrait Bruno here. We started looking at fair value gaps in one of my videos where we actually said that it is a three candlestick pattern where the first candle and then the third candle, their wicks do not overlap within the body of the second candle, of course, which is the expanded candle. Then we actually look at the science behind fair value gaps. We said these are liquidity void areas or price inefficiency areas where market has to respect or react from these areas. Then it leaves us a very big question: which fair value gap should I trade from, or which fair value gap will hold, which fair value gap will price react from? Okay, a typical example is where we have this bearish movement from this higher high into this lower low. So within the bearish move, we have this fair value gap here, and then of course another fair value gap here. Now the real question is, should I start placing my trade right away from here, or I should wait for price to disrespect this fair value gap and then of course get into this particular fair value gap like price did? Then I'll start placing my trade. And then another question is, the fair value gap is always a very big zone. Okay, so for instance, this particular fair value gap here, this one right there, this one right here, this one there. Okay, there are always very big zones to consider. So how do you react to these zones when price gets into the zone? Do you just start placing your trades and then expect price to move in your favor? No. So this video seeks to answer such questions. So stick with me till the end of the video. Do the YouTube drill, subscribe to my channel, hit the notification button, and then like the video, comment and share. Thank you for doing that. Let's get right into the video. Now, the number one rule to trading fair value gaps correctly is by determining the direction of the market. And then with market direction identification, there are a lot of information that you need to consider. You should not always look at the common thing that we all know, the high, high, lower, high, 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 lower, high kind of thing. That one alone to identify the market direction, I would say personally, is not reliable. But then, of course, you could look at liquidity, fair value gaps, institutional zones in the form of order blocks, supply and demand, and of course, and FU candles. These are institutional candles. Now, with the purpose of the video, we could just clearly state that, of course, gold is very bullish, looking at all the information outlined here, and then all the institutional zones that have marked, and then how price just respected this previous fair value gap. Then of course we could say that gold is bullish. Okay, but I do not only use the fair value gap to determine the direction of gold, right? I considered a lot of information: liquidity, supply and demand, like I said earlier on. Now let's consider the recently tested fair value gap here, and then try to see how we would have traded off from this fair value gap in the lower time frame. Okay, so let me try and do away with this drawing so that we can readjust the diagram. Of course, this is a refined zone, so I want to include the fair value gap, the whole area, on the daily time frame, and then we can see how it was refined going down in time frames. Okay, so this is the whole area representing the fair value gap. This is the third candle confirming the zone. So let's say price hasn't retested the zone, it was just this bullish move. Then we want to see, when price get back to the zone, how do we trade, or how do we react when price actually get back to the zone? So let's get a little bit down in time frame, and then so this whole area represents the daily fair value gap on the 4-hour time frame. But of course, you can also see the 4-hour fair value gap that has been formed overlapping with the daily fair value gap. Let me try and get a shape to distinguish between the 4-hour fair value gap and then the daily fair value gap. Let me change the color. I think I'll go with red. Yes. So let me try and readjust the shape into the 4-hour fair value gap right there. All right, so this is the 4-hour fair value gap in the red rectangle and then the daily fair value gap right there. You can see they are overlapping with each other. Then it follows that if price will make any true move with respect to fair value gap, then of course it will be from the 4-hour fair value gap. We are trying to refine the daily fair value gap. Then I can readjust this daily fair value gap right into to overlap with this zone. Then I'm left with no option than to reconsider the whole 4-hour fair value gap too, because price could just get into the zone very deep and then gives you that rejection. Now from here, I do not continue with refinement of the zone. Mostly I do stop at the 4-hour time frame, but going down in time frame, if there's something to refine, then quickly I jump into the 1-hour time frame, and then that is where I would stop with the refinement. From the 1-hour time frame, we have this fair value gap that was tested, and then of course this is the only fair value gap left within the 1-hour time frame within the zone that is not tested. So ideally I will refine the zone again to occupy the 1-hour fair value gap. So this is the only zone that is the fair value gap within the higher time frame fair value gap that is not tested. Then I can quickly do away with this particular zone right here. Now this will be my zone of focus, my point of interest, and then I expect price to trade back into the zone, and then I'll start looking for my trade setups. There are about 5 to 6 trading setups that I do look out for when price reacts from my point of interest, and I do look out for these zones in the 50-minute time frame, the 5-minute, and even on the 1-minute time frame. But mostly with the zone, if it is from the higher time frame, weekly, monthly, daily, then I want to look for the zones on the I want to look for my trade setups on the 50-minute time frame. If it is a scalp trade, then I'll look for the trade entries or the trade setups in the 5-minute and the 1-minute time frame. So right here with this point of interest, like we know, it is a refined zone from the daily fair value gap. Let's get straight into the 50-minute time frame and try to see if we can find our trade setups. So here we are. Price got into the zone perfectly, gave us that reaction. After price have respected my point of interest on the 50-minute time frame, which is a signal to me, the next thing I do is to start looking for my trade setups. Now, my number one trade setup is this 2 candlestick pattern right here. Now, the first candlestick is a doji candle, and then the second candle is a bullish candle, kind of like an engulfing candlestick pattern. The number one rule you need to consider is that this doji candlestick pattern here has been created generating liquidity, and then the next candle wicked below, taking the liquidity to the bottom side, and then eventually closing above the doji candle. Then quickly I'll take my first entry with the closure of this bullish candle right here, indicated with the black horizontal line. Then I'll place my stop loss at the low of the bullish candle right there. Let me change this to red to indicate where I'll put my stop loss. So my first entry right there, and then my stop loss right here. So we know price doesn't actually move in one-way direction. Eventually, if price get back into this area indicated between the black and then the red horizontal line, then I'll add more positions. But all the entries, my stop loss will be right where the horizontal red line is. The next trade setup has to do with looking for a fair value gap on the 50-minute time frame. Of course, the first fair value gap after price have respected your point of interest in the 50-minute time frame. So we have this point of interest from the daily fair value gap. Price got or had it respected, and then we will start looking for the first fair value gap in this bullish run. So just scanning through, I think the only first fair value gap I can see has to do with this tiny one right there. Let me grab this shape to indicate where the fair value gap is. So we have the first fair value gap right there. So the idea is that when the first fair value gap has been created after price have respected your point of interest, then you want to take your entries when price reverse back into the first fair value gap. Then you put your stop loss right there. Okay, so the recent low that leads to the creation of the first fair value gap. One thing I don't like about the second trade setup is that it gives me that huge stop loss if, for instance, the fair value gap is very wide enough and then the recent low that created the fair value gap is also wider or far apart from the fair value gap. So mostly I am very conservative in trading the second trade setup than the first trade setup. The same idea apply when you get down into lower time frame, 5 minutes, and then the 1 minute time frame. I use the same trade setups, just that with lower time frame, you can have the first fair value gap created, but of course, price will not respect that fair value gap, and then just continue trading away from your point of interest in your anticipated direction. So this is our point of interest from the daily zone on the 5 minute time frame. We have price came into it. So we look out for the first fair value gap, of course, which is this one right here. So the first fair value gap, then we anticipate price to come back into the zone, giving us that perfect reaction. So we have price came back into the zone right here. Let me use these lines to indicate the zone. So the zone there and then the zone here. So this is the first fair value gap that is formed in the 5 minute time frame. So we have price came back into it perfectly and then gave us that bullish run in our anticipated direction. So the idea is the same. It's just about you having that patience, waiting for price to come back into your zone, and then you look for your trade entries. And remember, always keep your stop loss at the right place. The point is that with lower time frame, price can just disrespect your trade setup and give you a very deep movement into the opposite direction of your speculation, and then you do not want to be in such move. In fact, you will be in a very deep drawdown, or you even lose the whole account if your account is not that huge. Okay, so always wait for price to give you that trade setup, and then you jump in. Keep your stop loss at the right place, and then if you are taking out, you wait for the next trade setup, and then you jump in again. That is the secret to trading successfully. So right here on the 4-hour time frame, this is our fair value gap area, very huge, of course, and this is the refined one. So we have price respecting it nicely, even as this bullish move. So this area right here in between the two lines is where we could have had our first trade setup and then jump into the market expecting price to give us that bullish move. And then the rectangle here, of course, is where our second trade setup will form. So you see the difference between the two. The first trade setup actually gives you the entry at the start of the move, and then the second trade setup actually gives you the entries somewhere in between the move. But eventually, with any of the two, you will actually be in the move. All right, just that the second one gives you a very huge stop loss when the fair value gap is actually very wide. So this is how you could have traded from this fair value gap right here. That is how I repeat the cycle every day, every time. Once I see the fair value gap form, I try to refine the zone and then go into lower time frame and then look for my trade setups. So this one right here, you could have gone into the lower time frame and then look for trade entries right here. Then you could anticipate the draw liquidity here, and then you catch some moves right there. So yeah, that is it. How to trade fair value gaps. See you in the next video. Peace out.